Hi, I'm Suzy Rhoades with Past Masters. Welcome to this week's Questions of the Week. The topic for this week is insurance-based products, life insurance. You can expect this topic to appear on the SIE exam, Series 6, Series 7, Series 65, and Series 66. We will take a 10-question topic quiz from within one of our Past Masters Securities courses. Let's check out our learning management system. Which of the following is incorrect regarding variable life insurance? So we're looking for the false statement. Always read all 4 of your answer choices. It has a fixed premium. That is true. It requires the delivery of a prospectus since it is a securities product. That is also true. It has a minimum guaranteed rate of return. Variable life insurance? That is incorrect. That is a false statement. Let's check the last choice. The premiums are put into the insurer's separate account. That is true. So there's 4 choices. It's always multiple choice on a securities exam. You're looking for the false statement. One statement is false. It has a minimum guaranteed rate of return. That is right because it's wrong. So within our learning management system, you'll click check answer. And then you'll see here we have the green check, meaning it is correct. You always have the option to click show explanation. Within each question, you have a written out explanation as well as an audio explanation. Which of the following is incorrect regarding variable life insurance? So you can do that with each of our questions within our securities courses. Your client just had twin boys and is worried if he should die suddenly, his wife will be left as a sole financial provider for the family. He is currently finishing his medical degree, so he has limited income. Which life insurance policy would you recommend? Always read all 4 choices. We have variable life, whole life, universal life, and 20-year level term. So we know that the client has a need and that currently the client has limited resources to pay a premium. So that is hinting at a term insurance policy. 20-year level term would be the most affordable in this situation. No cash value. Term insurance is pure protection only. The premium will stay the same for 20 years. In making a hypothetical illustration related to rates of return and variable products, which is true? Hypothetical illustrations are prohibited. Hypothetical illustrations are allowed as high as 12%, so long as a 0% return is also illustrated. Hypothetical illustrations are allowed up to 6%, or there are no restrictions. Hypothetical illustrations are allowed, and they can be as high as 12%, so long as a 0% rate of return is also used. So you can show the client really good, 12%, and not so good, 0%. The assumed interest rate in a variable life insurance policy is used for what purpose? Choices include to adjust the premium. Variable life has a fixed premium, so it's not that. To adjust the cash value, to adjust the death benefit, or to determine the rate of return in the separate account. The AIR, assumed interest rate in variable life insurance policy, is used to adjust the death benefit. So if the actual earnings are greater than the AIR, on an annual basis, the insurer will adjust the policy's death benefit, the policy's face amount. Which type of life insurance has a fixed premium, minimum death benefit guarantee with the ability to earn a rate of return similar to that in the stock market? Whole life, universal life, variable life, or 20-year level term? So rate of return. Does term have a rate of return? Never. It's pure protection. Universal life is tied to interest rates, so it's not that. Whole life has a minimum guaranteed interest rate. It is variable life that has a promise to pay the face amount when the insured dies. It is, however, possible that more than the face amount is paid when the insured dies, depending upon the performance of the stock market. So the premium is put into the insurer's separate account when you are purchasing variable life. The variable life policy will experience a rate of return similar to that in the stock market. Regarding taking a loan from a variable life insurance policy, which of the following is incorrect? So one statement's going to be false. The minimum loan amount that must be made available is 75%. Loans must be made available if the policy has been in force for at least 3 years. If an outstanding loan causes the policy's cash value to become negative, the insured has 31 days to make a deposit into the account so that it has a positive balance. Otherwise, the policy will lapse, or loans must be made available from the very beginning of the policy. So let's just pretend you had no idea. You can tell that there are two answer choices that contradict each other. So generally speaking, one of those two is going to be the correct answer. So the two that contradict each other in this question, loans must be made available if the policy has been in force for at least 3 years, or loans must be made available from the very beginning of the policy. So it's one of those two. Remember, we're looking for the false statement. So it's going to be right because it's wrong. The wrong statement is loans must be made available from the very beginning of the policy. In order to take out a loan, a policy must have cash value. And as a general rule, there is no cash value during the first 3 years of the policy. There is protection right away from the beginning, but there is no ability to take out a loan during the first 3 years. So that is the false statement, which means the other 3 statements, those are all true. Under Section 1035 of the Internal Revenue Code, which is treated as a taxable event. So we're going to look at taking cash surrender out of a policy, or maybe even an annuity, and moving it into another insurance product. If you do it correctly under Section 1035, it's a tax deferred event. It's not a tax-free event, it's just we're deferring the taxability until later on. So the IRS says you can never make your position better. So this question is asking which would not be allowed under Section 1035, which would be treated as a taxable event. So 4 choices: taking cash surrender from life insurance to buy an annuity. Is that bettering your tax position or just deferring the taxability? It's just deferring the taxability. So that is allowed under Section 1035. Taking cash surrender from one annuity to buy another annuity. That is perfectly allowed under Section 1035. So it's a tax deferred event. So annuity to annuity, allowed. So it's not considered a taxable event. Taking cash surrender from an annuity and funding an IRA. I'm going to put a question mark by that one. Taking cash surrender from one life insurance policy to buy another life insurance policy. That is allowed. So it's easy to remember you can go from an annuity to an annuity under Section 1035. You can also go from life insurance into life insurance under Section 1035. You can also go from life insurance into an annuity because an annuity does have tax consequences upon withdrawal. What you cannot do, you cannot take cash surrender from an annuity and fund an IRA. That would be considered a taxable event. It's also true that if you were taking cash surrender from an annuity and using it to buy life insurance, that is not allowed under Section 1035. It would be considered a taxable event. So just slow down on the 1035 questions. You've got it. The type of life insurance that has a flexible premium, 2 death benefit options, and a current interest rate is universal life, whole life, variable life, or 20-year level term. So we have some keywords in the question. Remember, you're a detective when you read your test questions. Current interest rate, universal life. Universal life has a flexible premium and 2 death benefit options. So as you pay in your premium, you choose whether or not you want death benefit option A, which is term insurance, face amount only, or if you want to pay extra for death benefit option B, which is term insurance plus the policy's cash value. Anytime you have a positive cash value and you decide not to pay the term insurance side of the policy's premium, you can take the money out and apply it to the term insurance portion of the premium, and it's not considered a loan. So when they say flexible premium for universal life, that's what they're trying to get at. Universal life's cash value will earn a current interest rate that is reflective of what is being earned in the economy at the time. It is going to be reset on an annual basis. It also has a minimum guaranteed interest rate. So when do you think universal life is popular? When interest rates are low? No. Universal life is popular in times of high interest rates. Which statement is incorrect regarding life insurance? In a universal life policy, the cash value earns a current rate that is adjusted annually. Yes. So the test is like this, where you can learn things. One question teaches you something that helps you with another question. That's always nice. You can buy life insurance on anyone. No. If you could buy life insurance on anyone, you'd go follow the ambulance as it went down to the hospital. You can't buy life insurance on someone unless you have insurable interest in them. So I'm pretty sure that's going to be the answer that is correct because it's a false statement, but I'm going to double check to make sure that the other 2 statements are both true. In a variable whole life policy, the insured has the risk related to the rate of return in the separate account. That is true. A separate account invests in the stock market. There is no guaranteed interest rate in the stock market. So the insured is taking on the risk. In a traditional whole life policy, the insurer has the risk related to the rate of return in the general account. That is also true. With a traditional whole life policy, the insurer promises to pay, let's say it's 2%. If the general account earns less than 2%, they promise to pay the insured 2%. If the general account earns 12%, they promise to pay the insured 2%. So they know what they're doing. They've got that all figured out. So the false statement, you can buy life insurance on anyone. No, you can only buy life insurance on persons that you have insurable interest in. Yourself, your family, and maybe a key person in your business. Last question. Which type of life insurance allows the insured the ability to self-direct funds within the separate account? Variable life, variable universal life, whole life, or universal life. So of those, there's only 2 that have a separate account. It's either variable life or variable universal life. It's the VUL policy that allows the client to self-direct funds within the separate account. That concludes our questions of the week for this week, insurance-based products, life insurance. Be sure, if you learned something in this video, to give it a thumbs up. Subscribe to our channel if you're not a subscriber already, and turn the notifications on so you don't miss next week's questions of the week. Thank you so much for watching. If you have any questions at all related to this topic, just ask me in the comments below. If you would like to look over our securities course offerings or to enroll in one of our courses, there is a link found in the video description below. Happy studies! I hope to have you as a student soon. You got this.